If you earn $80,000 and claim nothing, you can hand over around $17,500 in income tax and Medicare levy in a single year, according to MoneySmart. That's more than 3 months of salary. By the end of this video, you'll know exactly how the system works and how to keep more of yours. The backbone of the whole system is the tax-free threshold. According to MoneySmart and the ATO, Australian resident taxpayers pay zero income tax on the first $18,200 of taxable income each financial year. Everything above that gets taxed in progressive bands, which is where the confusion starts. Here's why this matters. Many people think that if they go over $45,000, all their income is suddenly taxed at 30%. So they avoid extra shifts or turn down pay rises. According to MoneySmart, that's simply false, and that fear can cost thousands in income they never even earned. Step 1 is to find your actual taxable income. Log into ATO online through MyGov, link your ATO account, and view your latest income statement and tax return. According to MoneySmart, your taxable income is your total income minus deductions, so it's usually lower than your gross pay. Step 2 is to match your taxable income against the resident tax table on MoneySmart. For both 2024-25 and 2025-26, residents pay zero up to $18,200, 16% to $45,000, 30% to $135,000, 37% to $190,000, and 45% above that, according to MoneySmart. Critically, only the income inside each band is taxed at that band's rate. Let's prove it. A resident earning $50,000 pays about $5,788 in income tax. According to MoneySmart calculations, that's an effective rate of only around 11.6% of total income. Nowhere near the 30% top band rate people fear. This is the payoff of Step 2. If you pick up an extra $5,000 of overtime, even taxed at 30%, you still keep $3,500, according to MoneySmart's band structure. Understanding this stops you turning down genuinely good money over a misunderstanding. Step 3 is to audit and claim your deductions. Gather records for work-related expenses, union and professional fees, self-education, and personal deductible super contributions, then enter them in your tax return through ATO online via MyGov. According to MoneySmart, deductions reduce your taxable income, which directly lowers the tax you pay. Here's the dollar impact. According to MoneySmart calculations, an $80,000 earner who legitimately claims $5,000 in deductions drops their taxable income to $75,000 and saves around $1,600 a year in tax and levy combined. Over 30 working years, that's roughly $48,000 in extra tax avoided. A powerful version of Step 3 is using super as a tax tool. According to MoneySmart, you can make personal deductible super contributions within the concessional caps, which turns income into pre-tax super and reduces your taxable income. On $80,000, a $5,000 contribution saves about $1,600 in tax and levy each year while still building your retirement. Step 4 is to confirm you're correctly assessed as an Australian resident for tax purposes. Review the ATO's residency criteria and check the residency answers in your tax return through ATO online. According to the ATO, residents access the $18,200 threshold, while foreign residents pay 30% from the very first dollar. Getting residency right matters enormously. According to MoneySmart and ATO figures, on $80,000, a foreign resident pays $24,000 in tax, while a resident pays $14,788. That's a difference of $9,212 in a single year before Medicare levy. Finally, keep an eye on what's coming. According to PwC, the 16% marginal rate on income between $18,201 and $45,000 is legislated to fall to 15% from the 1st of July 2026, and then to 14% from the 1st of July 2027. That's a tax cut for every resident in that band, so recheck the tables each year. Before we recap, here are the traps that cost the most. People assume their top bracket applies to all their income. They skip deductions they could easily document, and they forget tax offsets, like the low-income tax offset. According to MoneySmart, Offsets reduce your tax payable directly rather than your taxable income. So missing them means overpaying even at the correct rate. Let's run the checklist. Find your real taxable income in MyGov, match it to the resident tax bands, and stop fearing extra income because only the top slice is taxed higher. Then audit your deductions. Use deductible super where it makes sense and confirm your residency so you get that $18,200 tax-free threshold. If this cleared up how Australian income tax actually works, hit subscribe so you don't miss the next Plain English Explainer. Next up, we break down exactly which work-related deductions the ATO will accept and how to document them properly so you can claim every dollar you're entitled to with confidence.